Hi, I'm Max Keiser. Welcome to the Keiser Report. Special, insane, made edition. Woo! Dominic Claude Strauss is in the house. Hey, Greek people, I got some quantitative easing for you. Hey, Irish people, how about you? Portuguese people, woohoo! Yeah, that's the IMF for you. Let's bring in Stacy Herbert. Stacy Herbert?
Well, Max, this whole suicide banking, crazy, insane banking model is spreading to the entire world. Everybody is acting like a crazy banker. Headline reads, South Korean staged bomb blast to cash in on stocks. Now, this guy obviously learned from Hank Paulson. He was the best at this, the all-star at this. A South Korean man staged 2 minor bomb attacks with homemade explosives in Seoul last week in an attempt to cash in on stock investments by affecting market sentiment, police said. They said, quote, he invested 50 million won, or $46,000 this month, and said he believed bomb explosions will send stock markets falling, given the concerns of terrorism after Osama bin Laden's death.
Well, this is a huge issue. This man has stumbled upon something very important. Markets are over-leveraged. Markets are reflective of hundreds of trillions of dollars in leverage. So yes, a small $30,000 or $40,000 bomb can cause markets to crash because they're so highly leveraged by the professional hedge fund managers. $500,000 on 9/11 caused a multi-trillion-dollar collapse. $45,000 investment here could cause a multi-billion-dollar collapse. This is not really this guy's problem so much as the problem of the markets themselves. They're over-leveraged because of the fraud in the the IMF, the World Bank. Hey, here's Robert Zoellick. Here's Robert Zoellick and Dominic Strauss-Kahn having a meeting at the World Bank. Hi, hello, how are you? Yeah, I love maids too. Yeah, I love it. Yeah.
Here's another quote from the policeman in the situation, which is important to address because he doesn't take it as seriously. People don't take these flash crashes and Hank Paulson holding the American population hostage. We see no intention of political terror here, the policeman says. The suspect was just trying to affect market sentiment.
Again, let me emphasize that due to propaganda, they have successfully delineated between financial terror and political terror. This has been commingled into one global financial terrorist dominated global economy. There is no political terror anymore. There is no ideology. There are no political parties. There are no religions. There are no country boundaries. There is only the market, leverage, and events to make the prices go where you want them to go. This guy is the Hank Paulson of the retail side. He is, basically, the equivalent of Hank Paulson going into a liquor store and knocking it over. But he's the same mindset. They're from the same mother. They're sprung from the same Dominic Strauss-Kahn type semen. Woo, yeah.
Well, so here it's not political terror, it's just affecting market sentiment. So let's look at the head politician of the world, see if this is political terror or just affecting market sentiment.
Let's look at those head politicians.
Headline reads, Obama says U.S. default may unravel global finances. So is this Obama doing the same thing? So he's trying to get the Republicans, scare the population into convincing Republican politicians to vote for an increase in the debt ceiling. Not that it matters, apparently, that you even increase it technically.
Right. Well, if I had a blue and red balloon together, we'd get the right color for Obama. But let's say that you could create the Obama version of this. Yeah, if you don't raise the debt ceiling, we're gonna bust all over you, poor maid slave people out there.
Okay, I think that's going far enough.
Well, Obama is a financial terrorist, just like Dominic Strauss-Kahn, just like...
No. The South Korean police would say he's just trying to affect market sentiment. It's not terror.
Right, sentiment, not prices. They don't even understand that sentiment drives prices.
Well, so now that you have, the President of the United States going in front of the people via Face the Nation, a program on CBS, and telling them, you better, the entire financial system is going to unravel unless you give us more debt. Well, look at this headline. RBZ urges gold-backed Zim dollar. So this is the Reserve Bank of Zimbabwe, and their chief, Dr. Gideon Gono, is advocating for a gold-backed Zimbabwe dollar.
Gideon Gono. Yes, well, he made quite the stir when he introduced the $100 trillion Zimbabwe note. They went through hyperinflation. Now they're the first into a gold-backed currency. Now here's the thing. According to game theory, which of course drives the global economy in this highly leveraged fakakta world, if one country goes to a gold standard, there's going to be a lot of money actually going into that currency. It'll force other countries to go into a gold standard. Bravo! Bravissimo!
I remember once Dr. Gono started printing madly before the hyperinflation that led to the 100 trillion Zimbabwe dollars. On the Central Bank of Zimbabwe's website, they actually cited the US Fed policy and Bank of England policy of quantitative easing, that they said they were doing the same thing. Well, their currency has now collapsed, and now they're saying, okay, well, everybody's going to abandon the US dollar because we know, because we copied them. And look what happened to us. So now we're going to, he says, quote, Zimbabwe is sitting on trillions worth of gold reserves, and it is time we start thinking outside the box for our survival and prosperity.
It's going to work. I totally recommend Gono to do this. I've been hoping that some country, in fact, does exactly this. I thought China or India or Brazil would be the first country to have the first mover advantage. And in this case, first mover advantage is going to be huge, because once you get into that gold standard, people are looking around at fiat currencies and they're like, where can I get an actual resource-based currency? Oh, the Zimbabwe dollar? I'm in. And this is going to bring huge amounts of capital into Zimbabwe, and they'll make them an international global player.
Well, okay, and then some could look at Zimbabwe and think, okay, they've had a hyperinflationary collapse, they're run by maniacs, but then look at who else holds the US dollar. Who's the biggest bond fund trader in the world, Max Keiser?
PIMCO!
Well, they're in this next headline. Bullish on cognac, yogurt, and gold. So Fortune magazine interviewed PIMCO's equities portfolio manager, Anne Goodfein, and she said, quote, the largest position in the fund is gold, which we think is a very good form of protection against what could go wrong. We were encouraged by the fact that a lot of central banks, especially in Asia, are big buyers. We think that's an underlying trend that's very favorable for gold.
That's right. Well, Bill Gross's main fund over there at PIMCO, due to the way that that fund is set up, the charter that created that fund, he's not allowed actually to own precious metals. But he's a believer in inflation, if not hyperinflation. So you would naturally think he'd be a buyer of gold. So here's one of his satellite funds actually buying gold. So now the circle has been complete. PIMCO is pimping gold, as he should be in this environment where the bond market will get creamed.
Well, there have also, as gold and silver have corrected over the last 2 or 3 weeks, as they've had big declines, silver up to 30%, there have been all sorts of shouting and screaming, especially in the BBC, saying, it was a bubble, it's burst, it's popped. So what do these sort of people, who do you trust? For example, the largest bond fund trader in the world or the BBC?
I trust the actual people who are dealing with money day to day, not the lackeys at the BBC who are an extension of the corrupt government. And after the Hutton affair, of course, the BBC lost all objectivity, and they're in the pocket of those nasty number 10 Downing Street apparatchik.
Well, and this goes on to the other thing. So gold, as I said, fell back. Here's the headline. Gold coin sales reaching one-year high signal no end to rally in history. So this is from Bloomberg, another big financial news service. The U.S. Mint sold 85,000 ounces of American Eagle coins since May 1st, as the Standard & Poor's GSCI index of 24 raw materials fell 9.9%. The last time sales reached that level, bullion rose 21% in the next year.
Freedom is on sale. As I explained on this show many times, Stacy Herbert, in particular with the price of silver, when it got up to the price of JP Morgan's stock price, that there would be a huge turbulence because JP Morgan was going to defend that price because they've used their own stock to collateralize against naked silver short sales. Just like Enron used its own stock to try to keep the wolves at the door and then eventually collapse to zero, JP Morgan stock will collapse to zero at some point. So when it got to that price of JP Morgan stock in the mid-40s, then you had JP Morgan pull in a lot of favors with the Fed and the Treasury and the global banking system and the various sisters of deceit led by Diamond and Tim Geithner. And they stage an attack on silver as they've done before. But they can only attack it so much because what they've done is they've radicalized more silver buyers. The Silver Liberation Army has been radicalized by more of these attacks. And so you've got a much wider base developing, which will translate into a much higher amplitude and the eventual target of $500 I'm sticking to.
It's not just the U.S. Mint that sold a record amount. Rand Refinery, which sells the Krugerrands, which mints Krugerrands, they also had record month. Also, UBS had a record month in selling gold. So, but this is that big theme that we've said to focus on for 2011. That's the collapse of the U.S. empire, which is the collapse of the dollar. And you'll see that there's no getting around it. And final headline, Max, this shows you without any doubt, just like this PIMCO story, that the dollar is ready to collapse and gold, therefore, will be the new currency. JP Morgan's hunt for Afghan gold.
Huh?
So,
what? JP Morgan, what? Tell me more.
A team of bankers starts to tap the country's vast mineral riches with help from the Pentagon. So JP Morgan Capital Markets are in Afghanistan, backed by the Pentagon, and they believe that Afghanistan represents a gigantic untapped opportunity, one of the last great natural resource frontiers, and they reckon it has hundreds of billions of dollars worth of gold, and they're in there to acquire that.
Yeah, they don't want to pay $35 an ounce for silver or $1,500 an ounce for gold. They want to pay nothing. They want it free. They want to have the U.S. taxpayer finance the Pentagon to go into Afghanistan, murder a bunch of people, destroy the civilization, kill the culture, and steal all the resources. That was the strategy in Iraq with oil. That's the strategy of the Pentagon / JP Morgan / Goldman Sachs around the world. These two have fused together. Now, how somebody can argue that this isn't some, bastardization of fascism, explain to me how this isn't fascism when you've got the banks and the Pentagon fused together and the Pentagon bombs the country and the bank steals all the precious metals? How is that a sustainable foreign policy, and how is that not going to lead to social unrest and all kind? Huh?
Max,
What?
Listen,
Talk to me.
Listen, this goes in with the collapse of the dollar and the collapse of the empire, the fact that the U.S. is the empire. The article states this wealth, all these natural resources in Afghanistan, has lain there mainly undisturbed for thousands of years as armies of Persians, Greeks, Mongols, Britons, Russians, and now Americans tramped above. Invaders have dreamed of exploiting it since the time of Alexander the Great, but no one has yet succeeded on a large scale, and I reckon the U.S. won't succeed either.
No, that's where the empires go to die. Hey, before we go, let me do my impression of Dominic Strauss-Kahn when he arrives for his first night in a prison cell surrounded by a bunch of hardened criminals. Oops! Well, buddy, got to learn some new tricks. All right, that's going to do it. Stacy Herbert, thanks so much.
Thank you, Max.
When we come back, much more coming your way, so don't go away.
Years ago, the largest country in the world disintegrated. What had been one became many, and each began a journey. Where did it take them?
Welcome back to the Keiser Report. Time now to go to Boston and speak with energy analyst Gregor McDonald of Gregor.com. Gregor, welcome back to the Keiser Report.
Good to see you, Max. It's great to be back.
All righty. On your blog, you write paper versus real, exit from normal ecological economics and probabilistic regimes in one chart. Wow, you got all that in one chart. The chart is the 30-year Treasury bond versus the CRB, the Commodity Research Bureau Index. Tell us about it.
It tells us a couple of things. First, let's just note that since 2002, the U.S. dollar, as expressed either in dollar terms or just in terms of U.S. Treasury bonds, has lost about 65% of its purchasing power against a broad basket of commodities. And I just find that with this latest ramp up over the last 2 years in worldwide commodity prices, that in the global financial community, there's a real reluctance to own up to the fact, to face up to the fact that paper currency is losing its purchasing power against natural resources. So I do think as a starting off point, it's worth just pointing out empirically that the U.S. long bond has lost 65% of its purchasing power against natural resources, which are all the things that we use to live every day.
Since what year?
Since 2002.
Okay, so the 65% loss of purchasing power against resources, the stuff that you buy with that paper money, and the DXY, the actual dollar index that people look at, that has not depreciated 65% since 2002. So I think what you're saying here is that there's a bit of a complete disconnect in terms of comprehension on the part of those who follow markets and follow economics, that they look at these technical indicators like a dollar trade-weighted index, but they miss the big picture here, that 65% of purchasing power of the dollar has been smashed since 2002. And I take it the trend is not good either.
No, it's not. And I don't understand why so many in the financial community regard these types of comparisons as arcane. I mean, as anyone who's retired or knows, we all use our financial assets eventually to command services, labor, resources, energy, food. And so what the financial community has cleverly been able to do is to talk about GDP in nominal terms, talk about corporate earnings in nominal terms, talk about the rebound since the financial crisis lows of 2008 in nominal terms, but to avoid talking about these figures in real terms. What does the S&P 500 buy you now? What does US GDP buy you now? What do those corporate earnings buy you now? They buy you a lot less of just about everything you need to run a business or to live in retirement. So, this is a reality that's sort of, behind the front page. And of course, we're starting to see professional money management. We're starting to see the first few professional money managers, like the University of Texas buying gold. We've got Jeremy Grantham at GMO in Boston talking about the problem of scarce resources. We're starting to see the first few escapees from the world of nominal, and they're starting to face up to the world of real.
All right, well, another factor in this is the percentage of income that people spend on food and energy. Now, in the developing world, that number is quite high. They make very little money, and a huge amount of it is spent on food and energy, like 50, 60% in some cases. In the United States and in other developed countries, up until recently, that number was almost negligible. So due to the growth of the fiat currency period after 1971 and the income that was derived from the bond market and the stock market and the artificially inflated housing market, this component of the household income was ignored. But now it's coming back with a vengeance. At what point do we start to see parity between the developed world and the developing world, where the entire world is going to be paying a lot more for food and energy on a pari passu basis, to use a fancy banking term?
Well, I love that question. Just a couple of things here. If we look at the United States in aggregate, the drag on rising food and energy costs doesn't look catastrophic yet. But if you look at the first three quintiles of Americans, in other words, the 60% of income income wage earners in the United States, you're actually seeing enormous stress among those first three quintiles of wage earners in the United States. And when you get down to the first quintile and the lower quintile, certain Americans are almost struggling against food and energy costs the way many other people are developing and all over the world, not just in the developed world, but in the developing world. Now, the larger issue is the fact that as we move through this world where we're posting, nominal prices, but everyone's living in real prices, we see certain asset classes absolutely collapsing. For example, like U.S. housing. U.S. housing got its first blow from the fact that it had been put into a bubble. But now it's really suffering from the fact that with food and energy costs, housing can't really recover in those conditions. And so housing looks like it's probably one of the prime victims of peak oil and the fact that higher energy costs are basically raising the real living costs of everything in the system.
All right, let's roll back for a second. You talk about the 3/5 quintile. So just to put that into layman's term, you're talking about 60% of the population is coming into the point of contact with stress in the terms of the rising price of food and energy. And the bottom 20%, the lowest quintile, is actually now, you could say, on par with a lot of the developing world who is struggling on a day-to-day basis, almost a hand-to-mouth existence. And this is creating in the United States social strata, which seems like it's completely ignored by the political class. Nobody running for president, for example, addresses the fact that the economy is producing a permanent underclass of people who, because, as you point out, due to the constraints in the energy industry constraining future growth, these people will be in the lowest 20% in perpetuity, because there's no way to climb out of that permanent underclass given the restraints on growth tied to the restraints in oil, correct?
That is absolutely correct. In fact, we've seen the price of oil globally basically leave a whole tranche of people, both in especially in the developed world, behind. The price of oil is now, of course, at $100 a barrel, and it's basically left behind the poor of the OECD, of Europe, of the United States. These are people that may never really be able to afford oil again. And you're right. I almost call this emerging America. It's almost like emerging market America, where a certain portion of our society is unable to feed themselves. They're unable to afford gasoline. We've got an extraordinary number of people. We're going to probably hit 50 million people on food stamps, Max. That's in a country of 300 million people, and supposedly the wealthiest nation on earth. 50 million people not able to feed themselves.
I want to talk about volatility for a second, because this is something that I think is completely under the radar. As the energy constraints start to kick in, and as countries start to actually hoard their own energy, from Saudi Arabia and other countries that are oil rich, they're saying we want to hold on to our energy. We don't want to export as much as we used to because there's not that much around. This is increasing the volatility in paper assets, and we see huge volatility in the currency market. Talk about that relationship, please.
What we have come to understand is that the steadiness and the consistency and the reliability of industrial growth is really the driver of what allows paper assets to hold and maintain their value. When you're floating paper assets, which is either promissory notes of zero maturity like cash, or some other promise, which is maybe a 10-year bond, those paper assets are basically promising to the holder of those assets that there will be future industrial growth that will occur at a profit, and the profit will be used to pay the coupons and to pay those paper assets back. And what we've seen is once we ran into the energy limit, okay, and I mentioned a 19th century scientist named Liebig who talked about limits within natural systems. Once we ran into the energy limit, then paper assets not only began to falter, but now they've become unstable. They've become wild. The Forex markets are wild. The foreign sovereign bond markets are wild and unstable. And I see very dim prospects that any holder of a 10-year U.S. Treasury bond or a 15 or a 30-year U.S. Treasury bond will be repaid in any sort of dollars or any sort of paper capital that will allow them to go out and purchase the food and energy that they need, this is supposedly their savings. And so at one time, Max, paper assets were a secure place to store your capital. They are no longer.
You do still have a group of rent-seeking predators in the banking industry who know that this volatility is real, and they know the causes of the volatility, but their answer is to put on a volatility spread on the volatility index They'll buy the put and the call simultaneously, and they'll pay for the spread, and they'll let this whole market and ecology collapse, knowing that the volatility itself will generate returns for them. And this predator class is really in charge of not only milking the system necessary capital, but to what extent are they actually adding to the volatility, Gregor McDonald?
Well, you've heard the expression IBG, YBG, which is I'll be gone, you be gone, you'll be gone. And that's sort of the credo of the short-term, global buccaneering trading capitalist who's not interested in externalities in the system, is not interested in future risks, basically just wants to play current volatility and bank short-term profits. And of course, this is sort of the tragedy of our system. We really do need to have the political complex and the financial complex working more in concert to address longer-term issues. If we were to address longer-term energy issues, climate issues, environment issues, it would bring down volatility. But since we're not addressing those, we're enhancing the volatility. We're almost enhancing the volatility just by the fact that we refuse to deal with these large, long-term pressures that we need to face.
All right. Gregor McDonald, thanks so much for being once again on the Keiser Report.
Great to be with you, Max, and have a good afternoon.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Gregor McDonald of Gregor.us. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.